Good evening and welcome to Money Matters. My name is Jim Butler with Videri Wealth Management, and my co-host tonight is Pat Dunn with Merrill Lynch. Welcome, Pat.
Good to see you again, Jim.
Good to see you. Well, we're in some interesting times. Even though we never like to date the show, not knowing when it's going to air, but really for the next 12 months we have some interesting things in front of us called an presidential election cycle. But it seems like the market is doing some interesting things as well, causing a little bit of anxiety or that uncertainty word in the market. What are you hearing from clients that is causing any amount of uncertainty?
It's interesting. The clients are concerned right now. It's not like they haven't been through this before. At the moment, they're feeling a bit of relief because after the big drop in August, the volatility in September calmed down a little bit, and we did not retest the lows. And so that bodes well for this not being the beginning of any kind of prolonged bear market or anything like that. In fact, the demographics are in place just for the opposite. But it also doesn't mean that we're out of the woods yet. We may at some point go down and retest those lows. But for the moment, the jobs growth is doing well. This should lead to more consumer consumption. The dollar increase is not as much on people's minds, and the negative of the dollar increase has been offset by the lower energy prices, both of which have led to job growth. And we see the American economy expanding modestly being the key word. We're not seeing tremendous growth going forward, but we are seeing growth.
Well, what happens if we in fact do retest the lows and we go through another period like we did in the late summer, early fall, and the market keeps selling off like it did several years ago, going back to 2008? What can we tell our investors to focus on in order to calm them?
I would say, and I have been saying, that to use this opportunity to make buys, because it's a temporary phenomenon. We're not entering another recession. We're not entering another bear market. At some point, the Fed will raise rates, and of course, there's been a lot of concern about when is that going to happen.
That's right.
But historically, markets are up 10% 12 months after a Fed rate hike. At the same time, we've got a presidential election, and you know that years of presidential elections are typically good years for the stock market.
Right.
So be aware that we may test the lows, and if so, be ready to make some good buys.
Well, it's interesting because I think you're right on with your thinking in that now when the market is somewhat stable, in other words, it's not falling off dramatically, nor is it going up dramatically, is a time to do some good planning. And some of that planning might in fact be building some cash positions in order to take advantage of buying opportunities, as you say.
Yes, and also take a look at where the growth is. Right now, the growth is actually in equities, particularly domestic equities, and developed markets overseas. So, and the growth is not in your traditional low-risk investments like bonds. They're actually high-priced right now, whereas equities are low-priced.
Right.
So having a long time horizon, that type of investor will do quite well in this environment.
Well, I think that's the key. It really does come down to time frame. As long as investors have cash to cover the shorter term needs, ranging from a vacation that might be coming up, an education, or a new home, anything that is relatively short term, needing to have cash to take care of that. But the longer term needs, which call it retirement or reaching a level of independence, I think those are the areas where one can achieve the above average returns as you're suggesting.
Another thing we advise our clients, Jim, is that if you are feeling a lot of agita in this market, have a year, have 18 months, have 24 months of cash flow needs in cash, so you can leave your investments alone and let them get through this turmoil.
Right, right. Yeah, very well put. Very well put. I like that. Shall we address a question from one of our viewers?
Sure.
Tim Watson from Wayne is writing in, and I'm going to paraphrase the question, and that is, what's the difference between a market order and a limit order when investing in common stock, for example, and why would you use one over the other?
Very common question that we're often asked, Tim. The difference is quite simple. A market order is an order to buy X, you name the stock, at this time, at the best price available at this time. It is an immediately executable order. A limit order, on the other hand, says, I'm willing to buy or I'm willing to sell X, but only if I can get a specific price. Those orders are what you call good till cancel orders. They are good for 30 days unless executed before. At the end of 30 days, they turn into a pumpkin unless it's renewed. And there's no guarantee that you will actually buy or sell that security.
What would be an example? If you use IBM, which is currently somewhere in the 160 range, give or take.
Well, a market order would be, Jim, buy me 100 shares of IBM right now. And you would execute that order right now. You might get it at 160, you might get it at 160 and a quarter, you could get it at 159 and 7/8.
Okay.
On the other hand, I could say, Jim, I really like IBM, but I think at 160 it's a little rich. If it dropped to 155 and a quarter, I'd be willing to buy 100 shares. Would you put in an order to that effect? Now, if it never goes down there, you won't get the execution.
Right.
If it goes down and plummets through, you could get it at a totally different price, but you're not going to pay more than 155 and a quarter. I do tell people, if you're going to put in a limit order, don't put it in at a round number. Don't put it in at 155. Put it in at 155 and an eighth,
Okay.
or 154 and 7/8.
Okay.
You know, it does increase the odds that you'll actually get it executed if the stock is moving in that direction.
Interesting.
Now, on the other hand, if you owned IBM and you said, not so sure I want to keep IBM in my portfolio for whatever reason, I'm not recommending or not recommending, it's hypothetical, and you said, gee, if it got to 164, I'd be willing to sell it. I'd say, okay, how about 163 and 3/4? Is that acceptable? It's not a round number. And you could place that order for me, good for 30 days.
Good.
I hope that answers your question. It's a very good question and one that we're often asked.
Okay, great. Thanks, Pat. And if you have a question you'd like to send in, the screen will tell you how to do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Well, we have a very interesting guest tonight. His name is Ken Milner with Kraut Harris. Ken is a real estate attorney, and we're all going to learn something tonight if we listen carefully. Welcome, Ken.
Thanks for having me. It's great to be here.
Well, you're in the real estate business in one particular area, and you were mentioning earlier that some regulations have changed as it relates to mortgage settlements. Does that regulation have a name?
It sure does, but you may not like that name. The name is called TRID,
Okay.
T-R-I-D. TRID is an acronym, And what makes it crazy is that it's an acronym formed from two other acts that are acronyms.
Okay.
TRID actually stands for the Truth in Lending and RESPA Integrated Disclosure Rule. Don't ask. TRID the T stands for TILA, T-I-L-A, or the Truth in Lending Act.
Okay.
The R stands for RESPA, or the Real Estate Settlement Procedures Act.
Okay.
And then, of course, you have this, integrated disclosure. Why we have to continue to do this, Jim, is beyond me. Why we sit there and use acronyms that have no meaning whatsoever to the public is crazy. All it does is make us have to explain things more to our clients, and since we get paid by the word, that's not a good thing.
Right. But what this affects or impacts are most of us as individual buyers of residential real estate. Is that correct?
That's absolutely right. As a matter of fact, the name that most of us have started to use when we talk about the new law is what we call the Know Before You Owe Act.
Okay.
The idea is you will know in advance what the real cost of your mortgage loan will be before you sign the papers. And not just the minute before you sign the papers, but 3 full business days before you sign the papers.
Are you suggesting that doesn't happen now?
I'm not suggesting it, I'm stating it.
Okay.
Yes, it doesn't happen. A lot of times what will happen is, through no fault of anybody, there might be changes that have taken place. For example, sometimes there's a delay in settlement, and a mortgage loan where a rate was good for 30 days, all of a sudden we find out that settlement's been pushed back beyond that 30-day period, and now instead of it settling on June 30th the way it was supposed to, it's going to settle on July 7th. Well, the mortgage company is sitting there and saying, well, gee, rates have gone up. We're no longer bound by this, 30 days. It wasn't our fault that everything was delayed. And the rates have now gone up from 4.5% to 4.75%. And that's what we're going to do. Does the mortgage company have the right to do it? Sure they do. The problem is that it's done at the last minute.
Okay.
There's no chance for the consumer to negotiate. There's no chance for the buyer to sit there and say, wait a second, if you're going to raise the rate on me, I want to go look at 4 other mortgage lenders and find out what's going to be going on here. So there's those kinds of last minute changes. There are last minute changes that take place because during the pre-settlement walkthrough that everybody has, usually it's right the morning before settlement or the night before settlement.
Right.
All of a sudden, there's been a problem with the property. Something that may have just happened because of a winter storm or because of a thunderstorm or something like that. A hurricane passed through and all of a sudden there's damage to the real estate. And now there has to be an adjustment made to the purchase price or some money held in reserve. Well, the mortgage company doesn't want that. They're lending money based on the fact that the real estate is worth a certain amount of money.
Sure.
If the real estate isn't worth that anymore, it's unfair to ask that mortgage company to continue to lend the same amount of money. So all sorts of last minute and under the table adjustments are made, and that's not good for anybody.
So what does TRID do to solve that problem?
TRID has basically taken the Truth in Lending Act, which you may recall is that act that says, well, once you apply for the loan and you get a tentative okay, you get that piece of paper that says, well, you're borrowing $250,000, but with interest, that loan over 30 years is going to cost you $400,000. You know that. And they take that TILA, the Truth in Lending Act documentation, and they take the Real Estate Settlement Procedures Act, or RESPA, and all of the costs associated with title insurance and all sorts of transfer taxes and fees and tax adjustments and all those things that have to be disclosed. And they've rolled it up into this one regulation that says, you know what? everybody should know well in advance exactly what this is going to cost the borrower, who now they call the consumer under the new act. And we're going to let that person know 3 full business days in advance. And there can't be any last minute adjustments at the table or anything else, or you've got to start the process over.
So for the consumer, for the home buyer,
Right.
what you're saying is they actually get to see all of these expenses, what used to be the HUD sheet,
The HUD-1 form, that's correct.
3 days before they go to the settlement table, so they know exactly what they're getting into.
Exactly. That HUD-1 is no more. It's now called a disclosure document, and it's given to you right up front, and that is not going to change. Or rather, that is the big change in terms of the documentation. So you will have to get that. It cannot be changed within that 3-day period. By the way, you mentioned we've been talking about going to settlement or going to closing. Another little facet of the law is that all of the language that we've used for real estate settlements for decades, maybe even centuries in Pennsylvania, is changing. It's no longer a settlement. It's now called a consummation.
Really?
Really?
Sounds a little
Now,
sexy to
is
me,
that-
maybe it's a good thing, but I don't know. Now it's called a consummation. And now, instead of a HUD-1 settlement sheet, there's now this disclosure statement. Instead of the buyer being known as the buyer or the borrower by the mortgage company, that person's now known as a consumer. And those are loaded terms.
Yes.
You know, here in Pennsylvania and federally, we have consumer protection acts. And we think that sometimes just by being called a consumer, somehow we're going to be protected by
Good point.
by using that. And nothing could be further from the truth. The fact is, no, there's no additional protections other than the fact that you're going to know what the numbers are 3 days in advance.
So when does this take effect?
Actually, it was supposed to take effect at the beginning of this past summer, back around July 1 of 2015. And then it was pushed off until October, first week in October of 2015. However, the kicker is this. We're talking about loans that originate after October
Okay.
2 of 2015. Okay? So you might have a settlement between October of 2015, October 2, and say, November 30th of 2015, and still be using the old forms and still be under the old rules.
Because the
Why?
loan originated previously.
Exactly. But as we move on toward the end of the year, and that's what's going to be crazy, is because that's when so many transactions take place, as you know.
Well, it's also a lot of people have to change their forms. All the real estate agents have to change their forms. The banks have to change their forms.
The agents are changing the forms as we speak. The mortgage companies have already changed many of their forms to comply with the new regulations, because it's no longer just the truth in lending, it's this truth in lending enhanced with all of these extra things. So all of the forms are changing. The settlement statement, this disclosure statement that we talked about, is changing as well. Everybody's biting his and her lip just a little bit.
So by the time many of our viewers see this show, it's very possible that the regulation may in fact be in effect.
That's correct. If someone is applying for a mortgage loan sometime after those first couple of days in October, we're going to be moving forward. It's that simple with the new forms, the new technologies, the new terminologies
Right.
as well.
Now, for clarification for our viewers, is this a national phenomenon or is this a Pennsylvania phenomenon?
That's a great question. I love questions like this. Questions like that show you're thinking, Pat. Next question. It's national. Truth in Lending Act and the Real Estate Settlement Procedures Act are federal regulations. They're not just state.
Okay.
So this is going on everywhere. The difficult part of it is that the rest of real estate law is state-based. Our Pennsylvania real estate transactions are Pennsylvania law. The general form, people see the PAR, the Pennsylvania Association of Realtors form that's so often used in agreements of sale. Our disclosure documents and everything else that are used are state regulated. And so what's happened is that you have 50 different states trying to all adjust their laws to fit the new federal regulations.
Is there anything that we as consumers, and we're all consumers here, just like our viewers, should be concerned about as a result of this process? Or should we be happy that there's going to be more disclosure, more time to view the documents?
Is it a positive or a negative?
Right, right.
It would be so easy to play the lawyer here and say, it depends, but I won't do that. I believe that eventually this will be a positive thing for everybody. Last minute deals are what create chaos.
Sure.
It's those under the table things that you're trying to avoid. Well, we don't want the mortgage company to know that there's a $10,000 adjustment because the roof is leaking. We don't want people to know. And so these side agreements are being made that nobody knows anything about. And that is when there are problems. When you have these last minute things that aren't properly documented, that aren't properly thought out. Sometimes even the attorneys, if they're there representing the parties, don't even know the extent of what's happening. So I do believe there will be less chance for last minute changes made, which will hurt the consumer. There will be less chance for there to be a hurried transaction in which there will be misunderstanding. And I think that knowledge is power. And once you have knowledge in advance, that's a good thing. You will know what to prepare for a few days before settlement. You'll know exactly what you're going to be paying and when. And if it doesn't work out, if there is a last minute problem, you get to take a breath and start all over again. There won't be this pressure to settle at the last minute, to sell or to buy. And we won't have that. So eventually it'll be fine. Right now, I think it's going to be problematic for everyone, not just buyers and sellers, but for everybody in the process because of the changing of the forms and everything else. And I think it's going to take a while for everybody to adjust. But it's not new. We've adjusted before. We'll adjust again.
Right, right. Let me shift gears a little bit.
Sure.
We're winding down on our time slightly, but another area of expertise you have is forming a business, and somewhat specifically in the state of Pennsylvania.
Correct.
And is that geared more to the small business person versus a medium or large size company?
I represent companies of all sizes, obviously, but a lot of my clients are small business clients. And there's a new law in Pennsylvania which has passed and is effective as of July 1. And that's the new entity transaction law in Pennsylvania,
Okay.
which has made Pennsylvania, for many people, the new go-to state.
Really?
Really? Over Delaware?
Isn't that amazing? You know, people have always said, oh, we're going to form a Delaware
Or
company.
company.
There's two basic reasons to form a Delaware company. The first is the tax laws, and there's still many tax breaks in Delaware, which make it a great choice for businesses, particularly those working in intellectual property and licensing out things. Delaware is still tops when it comes to that. But the other reason that people have used Delaware for so long is that Delaware and their corporation law and all of the laws that follow with other entities has always made it very easy for people in charge to make changes, to have major transactions, structural things. and it gives the board of directors and people who are in charge tremendous leeway. Back in 1988, Pennsylvania decided to outdo Delaware. They turned around and they said, we're going to out Delaware. We're going to make it as easy as possible for directors to do things and to make changes, change the structure, this, that, and everything else of the company. And there were some things put into place to do that, with some protections for minority shareholders and minority interest owners. The one thing that didn't change in Pennsylvania was how difficult it is to change the type of entity. If you have a corporation and your accountant has said, boy, it would be great if you could change it to a limited liability company.
Right.
In Pennsylvania, what you would have to do would be to dissolve the corporation and start a new limited liability company. The cost and expense was tremendous. The time consumption, getting clearance certificates, doing what you had to do to dissolve the one company and start up the other was both time difficult and expensive.
Not to
Now-
mention trying to run the business while you're
you're
trying
doing
to
all
do
that.
all of this. Yes, I understand.
That's for sure. So what Pennsylvania has done is they said, we're going to make it incredibly easy. You're going to be able to basically file a couple of documents and change your S corporation to an LLC. Not only that, you're going to be able to do mergers much more easily. You're going to be able to have a third company go ahead and swallow up two other companies much more easily. Other than Arizona, I don't think there is another state right now that has come up with such a far-reaching plan to make it so easy to change the structure and form of an entity.
Then answer this. Is this something for LegalZoom? Or is this something where you need an attorney?
Ken, you have 30 seconds or less to answer that.
Good, because you wouldn't want to hear a longer answer. I don't believe that a company like LegalZoom makes sense for anybody. LegalZoom basically is saying, we can give you the form, file,
Right.
and you've done it.
Right.
But LegalZoom can't sit there and tell you, well, this is the situation in your life. You're better off being an
Here.
S corporation than an LLC.
Right.
They're not the ones who are going to sit there and say, especially in Pennsylvania, are you manager managed or are you member managed? What's best for the individual?
Ken, let me interject. We're out of time. Again, we touched on this, and the takeaway is Delaware still has advantages, but now so does Pennsylvania. So anyone thinking about forming a company or a business in PA should absolutely give it a second look and seek out appropriate counsel.
Absolutely, and so should anybody who's dealing with businesses in Pennsylvania.
Yeah, great. Thank you. Our guest next week is going to be Beth D'Souza. She's going to talk to us about new vision testing procedures that her company gets involved in. So thank you for listening, and always remember, your money matters. Made it.